Imagine a digital notebook. This notebook isn't kept in one place. It's shared among many people, across a vast network of computers. Every time someone adds a new entry, everyone gets the updated copy. This shared notebook is the basic idea behind a distributed ledger technology, or DLT. It's a database that is consensually shared and synchronized across multiple sites. Institutions' geographies. Blockchain is a specific and honestly the most famous type of DLT. Think of it as a special kind of digital notebook where entries are linked together in a chain, making it incredibly secure and transparent for everyone involved in the network. For generations, we've relied on central authorities to manage our most important information: banks, governments, large corporations. They acted as trusted intermediaries, holding the master copies of our financial records, property deeds, and identities. This old model can be slow, expensive, and vulnerable to single points of failure or even manipulation. What if we could create a system where trust is not established by a central institution, but by the network itself through collaboration, cryptography, and clever code? This is the fundamental shift that DLT and blockchain represent. This new digital ledger is not just a database, it's an incorruptible record of transactions. Each transaction is grouped into a block of data. Once a block is filled with information, it's added to the chain of previous blocks, creating a chronological and unchangeable history. Each block is cryptographically sealed to the one before it, forming a secure and resilient chain of information. This structure means that once a piece of information is recorded on the blockchain, it becomes nearly impossible to alter or remove it without the consensus of the entire network, ensuring a high level of integrity and permanence. Consider the process of sending money internationally. Today, this simple act involves a complex web of intermediaries. Your bank talks to another bank, which might talk to yet another correspondent bank, all before the funds finally reach their destination. Each step in this process adds time, adds cost, and creates a potential point of failure. With a distributed ledger, this process can be radically simplified. Complex traditional flow versus simplified DLT flow. A payment can be sent directly from one person to another, peer-to-peer, recorded on the shared ledger in a matter of minutes, not days. Think about buying a house. Lawyers, escrow agents, title insurance companies, government record offices. A DLT could streamline this entire ecosystem into a single, secure process. The property title could exist as a unique digital asset on a blockchain. Smart contract, self-executing code. Code automatically transfers title when payment is confirmed. Result, a more efficient and less costly system. The core difference between distributed ledger technology and traditional databases is the shift from a centralized to a decentralized model of control. In the old world, a single entity, like a bank, owns and manages the master ledger. They have complete authority to add, modify, delete entries. You must trust that they will manage this ledger accurately and fairly, but creates a single point of failure. If their central server goes down or is compromised, the entire system is at risk, and the data can be lost or manipulated. A distributed ledger, by its very nature, operates on a fundamentally different principle. There is no single owner of the ledger. Instead, it is shared and maintained by all participants in the network. No single person or organization can make a change without the agreement of the network. This creates a democratic and resilient system. Ultimately, these technologies represent the second era of the internet, an internet of value, promising to reshape our institutions and our economy for the better.